Hello and welcome to Investors Hangout, your weekly guide to making smarter financial decisions. This series is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, markets have been volatile lately and people have been apprehensive. People are panicking, they're anxious how to tide over this period. So today, let's talk with Dhirendra Kumar and discuss how to tide over this period and if you can still build wealth with mutual funds. Welcome, Dhirendra.
Thank you.
First question. In the past few years, we have seen data, a lot of reports that suggest that mutual fund investors, the number of mutual fund investors has risen exponentially. But why is it still that most investors, they fail to create wealth with mutual funds?
No, I think, for the first time in the last 4 or 5 years, we have large number of Indians doing their SIP. So I'm hopeful that, a lot more Indians will actually build wealth by investing in markets through mutual funds. And more so the SIP fellows, all the SIP investors. Most investors, they lack patience. That's a very natural thing, We invest and we think that if it has gone up, then let's take it out. That itself looks like a reward in itself and greater disbelief. They are not long-term investors. And the other is, the emotional investing. Most of the time we are attracted to the market through mutual fund even by, greed. It is going up, let me catch the bus before and let me not miss it. And the converse is true. Market falls, you run away. And sometimes, you are in disbelief that it has taken so long to build it up, how can I lose it? Inconsistent investing. Most of the time, because of this lack of patience and the emotional drivers, or the emotions which actually drives our investing, we become inconsistent investor. We invest for some time, then we stop investing for some time, then we get fearful, then we swear to never invest again, then we start investing again at the wrong time. So inconsistency itself, is one thing, and the greed bit. When something has done exceptionally well, chasing performance is investors' favorite pastime, and that is what we end up doing. So these are, I think, the 4 reasons why it actually, why most investors are unable to build wealth with investments.
You mentioned emotional biases. So is there a way to overcome emotional biases in investing?
Yes, if you are able to link your investment to goals. For example, if you think that this money is for my retirement, which is 20 years away, which is 15 years away, and if you are disciplined about it, then you will not panic with, you start investing, 6 months later the market tumbles, and then you think that, oh, this is over. The moment you think that this is for 15 years, you can actually take a view. You can even forget to look at it in the interim. For a couple of years, you can just simply forget. Second is that, today it is possible to automate it. And I think there's a great charm of, there is a great reward of automating this. Something which gets out of your bank account, which gets out of your system, you are not tempted to spend it. Because the biggest problem of, not being able to invest is not that it will not generate good return or you will make some poor investment. You will spend it and you will not have that money in the first place. When you are a new investor, you look at the investment values every day. That causes anxiety. That over monitoring actually distracts you from staying the course. And then once you have, accumulated something meaningful, then be aware of the asset allocation, that you have to moderate your risk. You can't be fully invested in equity all your life. Once you have something meaningful accumulated, then you run the risk of losing it. People start fearing the loss at the outset itself when you don't have much to lose. So I think, being aware of asset allocation and rebalancing over time once you have something sizable.
Right. Now, with all your years of experience and during such lean periods, what do you think are some of the most common mistakes that investors tend to make while picking mutual funds?
Looking at a mutual fund, the first step should be to understand that which is the fixed income fund that you need, which is the equity fund that you need. But people do exactly the opposite of that. People just look at recent past performance. And that's a very dangerous thing. One thing which is, which is almost always true is that what that has done exceptionally well in recent past is immediately followed by doing exceptionally poorly very poorly in recent future. And that is called reversion to mean. It is an inviolable rule. That is how it happens. So chasing recent past performance is the biggest folly. And it's very difficult to ignore that. Most new investors think that this has done well, it is doing well, so let me write it.
Yeah.
But it depends how long it has been doing well. If it has done well for 8, 9 months, 10 months, maybe that by the time you are on board, it is time for the downturn. So making sure that why things work, how things are working, and being diversified is a very important thing. Then comes, ignoring consistency. There are funds which do exceptionally well, and the same funds do exceptionally poorly as compared to the ones which are, doing okay, and they are doing okay over a period of time. And that is what makes them an exceptional thing over a long period. Doing well in a bad market and doing not so poorly in a bad market, and doing not so well in a rising market, but doing okay. And that is what makes it a great long-term winner. And that is something, so people don't really attach much value to consistency. Third is that most people are attracted to something which might be a negative category. That is something which should not touch it. Okay. If you look at what has happened in the last one or 2 years, most investors are attracted to something like a thematic fund or a PSU fund or a EV fund, because at a certain level mutual fund is bought by individual investors. Investors, or most individuals or most people, they like listening to a story. And if the story looks very promising, or at least the narrative is that, if the argument is that, then they get attracted to it. So people chase those stories, and that eventually they turn out to be disappointing, even if they are well in the long run, because of those stories. Most of these funds are launched at a time when it is very inopportune, and that is when people get caught, and they get generally they never benefit out of it, because they are disappointed and they get over it. The most important factor, which I think it should have been the point number 1, which is be aware of cost. Everything else being equal, assuming that you own a fund, I own a fund, somebody else owns a fund, and we over a very long period of time, if it is a reasonably managed fund, we will all be functioning we will all be deriving a return in the range of plus minus 2%. I'm talking of a large cap fund. Everything else being equal, cost matters. Cost is a definite thing. Return is uncertain. Right. Where some years you will get, some years you will not get. Some years when you will not get, you can't do much about it. If nobody is going to get it in the market, your fund will also not earn. But everybody will incur expense. And that incurring expense, you have to make sure that you are on the lower income expense band. So there are funds, there are plans which are lower expense, there are funds which are lower expense, there are index funds which are lower expense. So be aware of the cost and be conscious of it, and try and be on the lower expense band.
We've always done this through our videos, reinforcing the importance of long-term investment. And more so in these times, for the past few months, we've been reinstating through your first page columns, through our videos, but there are a lot of questions that we're getting that if we don't withdraw, if we don't sell our investments when the markets are at a high, then when do we sell?
There are 2-3 reasons when you should certainly sell. One is that you are investing with a goal. As I was telling you, that everybody should start with a goal, then you should sell. Second is that sometimes our circumstances change. And by circumstances, I mean, you were investing for the long run, but now your long run is no longer, the time left is not making it long run. So you need to sell and move it to fixed income, a good part of it. Third is that, if you decided on investing in a fund because it was a good fund, and it is no longer a good fund, sell it. And how to define what is a good fund, what is not a good fund. If the fund has not beaten its benchmark over the last 3 years and 5 years, get rid of it. Rebalancing is very important. So rebalancing is one thing which you should keep in mind, and that will amount to selling some and booking some profit and investing in fixed income. This will create an opportunity to profit from these upheavals in the market. But I'll tell you that never forget the basic rule, that most of the money is made not by moving your money around. It is by sitting with your, by remaining invested with equities for a very long time.
Okay, so just because the market is going up or down, you should
Market
not
should
move your
not
money.
should
Should not
be the
dictate.
last reason why, market itself is not a reason,
Mm-hmm.
because you have to invest with your time frame, your perspective, your plan, and your comfort.
To sum it all up, if you had to list 5 unbreakable rules to build wealth with mutual funds, what would they be?
Stay invested through these ups and downs. Markets will remain like this. You have to change yourself. If you don't, you can't be wealthy. And the moment you are able to learn, navigate this, learn this, then I think you'll start feeling happy when the market goes down, and you will benefit a little bit by rebalancing or changing your allocation. This is something which brings in a degree of discipline in your own framework. Once you have something to lose, and that does not mean that you should do it every month. Do it every 3 months, every 6 months. Automate your investments, because what happens is our greed and fear cycle drives us to behave very differently at inopportune time. When the market has gone down, we are feeling depressed, we are very unhappy, and we stop investing. And when it has gone up, then we are inclined to invest. We just might be thinking to borrow to invest so that make up for the lost time or make up for the lost returns. Then I think the most important thing which comes to my mind is ensuring that we are diversified at all times. There will always be a segment of the market, sometimes the small cap, sometimes the banking sector, sometimes the infra sector,
will do
sometimes
well
the
than the
which will do
rest.
exceptionally well, and not little better. It will do so well that you will be thinking in terms of concentrating. That I think is a very dangerous thing, because things turn around when you least expect it. It comes as a surprise.
With that, we've reached the end of this discussion. Hope it will make you think harder and invest smarter. Now, moving on to the viewer's question, Narendra. Lakshmi Mahesh says, shall I go in for bond funds as I have investments in equity and FD?
If you already have your investments in mutual funds and FDs, you have made deposits, I would say that there's a great advantage of mutual fund, the debt fund, the bond fund, vis-a-vis a fixed deposit. One is that you make a deposit of 5 lakh rupees, and every year you earn interest. Even if it's a cumulative plan, you have to pay taxes on that. In case of mutual fund, you make a investment in bond fund. Till you take your money out, you are not liable to pay any taxes. It lies there and it keeps growing. And the nature of that fund, if you choose a short-term debt fund, or you choose a intermediate term, medium-term debt fund, it is not very volatile. If you choose a high-quality one, the risk of loss, there could be a nominal risk of loss, but it is not a significant risk of loss. 99% of the bond funds, short-term bond funds and medium-term bond fund held for 1 year and more, have given better return than what you earn in fixed deposit. And in most cases, you haven't even lost money. You have never lost money. Once in a while, if you bought it today and something extraordinary happens, 1 or 2 bond actually, and that too in extreme situations. But in case of bond fund, it's far safer than it is not exposed to that, like that of the equity funds. That I think is a great advantage. I would say that try your hand, a small part of what you have invested in fixed deposits in a liquid fund, or in an ultra short-term bond fund, or a short-term bond fund. And let me also tell you about the convenience of it. When you do a big fixed deposit, you have to choose a term, 1 year, 3 years, 6 months, and that is a term. And if you take it before that, you are levied a penalty, or you earn little lower interest. In case of mutual fund, it is liquid. You make your investment and you just choose to get your money back, or you need your money in 2 days time, redeem it now, and tomorrow it'll hit your bank account. So convenience, liquidity, and tax efficiency in terms of it's a great tax deferral vehicle. Try your hand with investing a small part into
Bond funds. All right. Well, that's a wrap on this discussion. Keep watching this space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.